report. Martin Wilkie, he's global head of capital goods sector research at Citi. It's great to have you here, Martin. So we're primarily talking about names like Vestas, like General Electric. For GE, by the way, how much does it trade off wind power?
Oh, it's only one part of his business, much more of a conglomerate. And obviously for companies like Vestas, they are much more pure play. But obviously the benefit here can ripple through many companies in terms of supplying turbines, supplying infrastructure, supplying transmission networks. And really what we're looking for over the next couple of weeks is, can we get the clarity that these incentives can drive investment? Because we have this big gap between the decarbonization of the grid that's targeted, as you say, by 2035 versus where we are today. And really that's what's going to be the focus over the next couple of weeks is what's the commitment and what's the clarity on getting these incentives passed.
Right. You're saying if, the bill in its current form passes the way that it stands, you see 30% upside to U.S. wind installation forecasts from 2025, possibly as soon as 2023. So sort of give us the base case and then the bull case at this point, and which are the companies primarily affected?
So the base case here is that we begin to see some benefit as of 2023. Obviously, there is a lag to building these products. I mean, typically a wind farm might take 9 months or so before it can become operational. And really what's being outlined in the CEPP, the Clean Electricity Program, is that utilities and suppliers will be incentivized to grow their power base from renewable power from 2023. So effectively 2022 is the baseline year. So if this goes through, you could begin to see growth coming from 2023. There are, of course, limitations. We know that transmission is a bottleneck. So if you do look at the Department of Energy report that your previous speaker referred to that talks about solar, in that even they say that a lot of this is actually going to come from about 2030 onwards. And when we look at the upside to the wind market, we've said it's about 30% upside from 2025 through 2030, but actually the market could be 5 times bigger annually than current forecasts from 2030 onwards. And that just reflects the build-out time and how long it takes to build some of these projects. So really an absolutely enormous opportunity. And as you mentioned earlier, you're going from roughly 40% of zero carbon in the US today, that's across nuclear, hydro, solar and wind, towards 80% by 2030. So you really do need this big investment. Obviously, right. It's not all just simply building out. We need the infrastructure on the transmission side. Much of that is in the infrastructure bill, which, as we know, could be going through in parallel. A lot of it is required for solar storage and technologies like that. So many moving parts to get this delivered. But as we see, the 30% upside is kind of our bull case for the next 5 years or so. But really, the real bull case is that wind installations can be 5 times bigger than what people are currently thinking by 2030. And even though that seems a long ways away, if we get clarity on that, then I think some of these stocks could begin to reflect what could be happening over that period. It's worth adding that this is not just the US. Going into this UN Conference of Parties in the UK that's been hosted in early November, other countries, other regions are going through similar programs. If we look here in Europe, the Fit for 55 program is also looking to massively cut carbon. So the US is just one part of many things that could be driving renewables over the next decade.
Shepard Smith here. Thanks for watching CNBC on YouTube.